Hey everybody, I got to do this. I read an article the other day and I just got maddened by the first paragraph. So I'm going to bring up this topic of using equities to keep up with inflation. And the key part here is in retirement. Okay, so that's really a big difference. In your wealth building years and your working years, absolutely, equities are an essential part of a portfolio. I don't have a problem with that. But let's talk about this when we transition into retirement. So here's the paragraph that just upset me quite a bit. And I'm trying to protect some people here with some editing. But let's read this. Holding equities in your portfolio in retirement offers some protection because they have proved to outpace inflation over the long haul. Advises clients, big company, advises clients to maintain a balanced portfolio, 50% stocks, 50% bonds, in the early years of retirement. It depends on the client's risk tolerance, but having equities in the portfolio helps you maintain the ability to spend from your portfolio, said the leader of this very large company. So I want to break this down a little bit. I broke out 3 sentences here, and I really want to talk about the issues I have. This is my outlet to vent, apparently. So this is going a different direction maybe than you thought. The first problem I have with this statement is they have proved to outpace inflation over the long haul. Well, what is the long haul to you? The last 40 years, all stocks had to do was earn 3-4% to outpace inflation. We hadn't really seen inflation since 1982 when everything started crashing back down. And then we maintained somewhere around 2 to 3% average inflation. We've controlled that for almost 40 years, actually over 40 years now, until we just saw that one little spike. Right now, just one little spike, one tiny little spike of inflation, which I think we all know those years that we saw inflation, the market did not keep up with that. So, sure, stocks kept up with inflation. But if you bought a 30-year bond in 1985, that did better than keeping up with inflation because you could have locked in 10%. So we just a blanket statement of stocks have outpaced inflation in the long haul. Well, look, it depends on what inflation is. We've seen nominal to no inflation for almost 40 years. And the reality is that we've had one little spike in those 40 years. That's about it. It's pretty easy to keep up with inflation when all we see is 2-3%. And interest rates, when we stopped seeing inflation, were in the double-digit range. It was real easy to keep up with inflation when we had double-digit interest rates out there and 2-3% inflation. So the next part of this advises clients to maintain a balanced portfolio, 50% stocks, 50% bonds. Well, first of all, should everybody have the exact same portfolio? Oh, let's say you're all 60 years old and you're all retired, or all 65 and all retired. Should every 65-year-old that's retired have the exact same portfolio? And the answer is, oh my, there's no reason for that whatsoever. How about this scenario? I know somebody that has $10,000 a month income between Social Security and pension income, but they only spend $5,000, and they care how much their heirs get. Should they have 50% bonds and 50% stocks? No, they can have 100% in stocks if they want to. Building wealth for their heirs is what their priority is because they have no need for that money themselves. It's that Warren Buffett scenario. Should we invest like Warren Buffett? Well, if you have Warren Buffett's money or lack of a need for the money that you have saved, then sure, invest like Warren Buffett. But Warren Buffett doesn't need to have 50% in stocks and 50% in bonds. They can have 100% in stocks. If you don't need your money, you don't need bonds, right? The other part of this that I have a huge problem with is, at what point do we change our mind on bonds? I don't get it. I don't understand what this grasp on what used to work should continue to work. I don't get it. It doesn't make sense to me. Bonds don't make sense, especially in a retiree's portfolio. If you don't think so, well, here, go look at every bond fund out there. I'm not picking on this bond fund. Look at the benchmark if you don't like this bond fund, or it has nothing. Every bond fund looks like this. 1 year, less than 1%. 3 year, -5%. 5 year, basically zero. 10 year, 1%. That's the annual average return of this entire portfolio. All the way back to 2001. Averaging only 3%. Look, here's the thing. Bonds do well as interest rates drop. That's why this chart of interest rates is here. These are bond yields. Bond yields back in the 80s when we saw all that inflation were way double-digit, wonderful, fantastic. But as bond yields drop, if you own an individual bond, the value of that investment goes up. So now we're getting paid double-digit interest and the value of that investment's getting bigger. That sounds fantastic. I loved bonds back then. Back then, bonds were fantastic. They did wonderful. I love getting paid double-digit interest and having growth in value of my portfolio. Owning bond funds was fantastic because the price of that bond fund kept going up and I kept getting paid interest. And all of those bond funds were filled with bonds from back in these days. But as they mature, because the 80s was 40 years ago, 40, it's hard for me to say that, it makes me feel old. Bond yields being in double digits were 40 years ago. Well, the longer duration of bonds is typically 30 years. Yes, there are a few longer ones than that, but very few. Most of these bond funds were filled with these 20, 30-year bonds that in our slide over the last 20 years of little to no interest rates, most of those old bonds have washed out of those portfolios. And now all we're seeing in yields from these portfolios is 2-3% in these bond portfolios, when now we have interest rates over 5%, 6% in some cases. So I look at this and go, just makes no sense. Why would anybody use these as safe investments? They made a lot of sense in the early 2000s because we still had all these bonds in these bond funds that were paying much higher yield. But now, no. Going forward, not in the near future do I see bonds making any sense, because we're going to continue to flounder at these lower interest rates. Most likely, if we happen to go back up to these double-digit interest rates, then lock in as long as you possibly can. But there are very few people that think our economy can handle that high of interest rates. We're already pushing the envelope at this point with all the debt that we have out there. So bonds, we're going to just see this floundering at the bottom, and the bond portfolios have not had those double-digit interest rates for so long that none of them have them in their portfolio. And then the regulators forced them to put treasuries in there, which, right now they look okay, but then go buy the treasury directly. Don't buy a bond fund. Makes no sense. So owning bonds doesn't make any sense. So everybody puts 50% in bonds and 50% in stocks, and that's supposed to work. Trust me, it doesn't. You haven't been able to pull from your bond portfolio for a couple of years now. Otherwise, you're selling losses. You're locking in real losses. Your safe portfolio is doing nothing for you. It's counterproductive when keeping up with inflation. So that portfolio makes no sense to me whatsoever when we're talking about having a stock portfolio to keep up with bonds. So then the last part of this. Having equities in the portfolio helps you maintain the ability to spend from your portfolio. Probably the worst statement of all. First of all, volatility is the greatest enemy of withdrawal, period. It's math, it's basic. Watch the video, the number one objective of a retirement portfolio. And I've got plenty of other videos that are directly addressing the math of volatility. It is absolute. This is a black and white rule that we have to live by when we start transitioning into retirement. Never withdraw from losses, period. The larger your withdrawal rate, the greater the effect of volatility. The number one objective of your portfolio in retirement is to have a place to pull from so you don't have to pull from losses. You can still have stocks in your portfolio. I want you to have stocks in your portfolio, but if you are going to need money from that portfolio, the more stable options that you have in there to pull from when the market's not doing well, the better you're going to perform in the grand scheme of things, the more money you're going to have ready for your pocket. And that's what's important in retirement. If you don't need your money, if you're Warren Buffett, if you've got all that income and you don't spend all of it, then put it all in the stock market. We don't have to worry about volatility. But this statement says that the stock portfolio is what's going to help you be able to spend this money. And it's actually the polar opposite. You have got to have some stable investments and a plan on where you're going to pull from when it comes to that volatility in the stock market. So some people are going to have and utilize stocks. Some people are still in their wealth building mode in retirement. This only applies to people that are trying to pull money out. You have to have a plan. Volatility is not what you need when you're talking about those withdrawals. So thank you for allowing me to vent. Hopefully this adds a little bit of perspective and insight to the stuff that we see out there in these articles, and then that is ingrained in our system. What used to work should always work in the future is not true. That's not how the investing world works. We can't just decide everybody should do it this way because it's what worked in the past. We have fundamental differences between the past and where we are today and where we're going in the future. So we have to treat that differently. Bonds are not necessarily the right place to go, but we do need those stable investments if we're choosing to be safe and have an efficient withdrawal system in there. Hopefully that helps. Give us a call, shoot us an email, subscribe if you haven't. We're trying to push past that 1,000 mark. So get in there. We're putting new videos on every single week, and now I'm starting shorts. And coming soon, 2024, we're going to have the full form classes that I've been doing for over 10 years. Give you the live stream and opportunity to join in those classes as well. Can't wait to see you. Talk to you next week. Thanks again.